Hey everybody, welcome to Money's No Object. I'm your host, Dylan Howell. I'll be more excited to continue sharing with you guys personal finance topics that I think can be useful for you in your long-term financial journey. Today, we are going to be asking the question as to whether or not diversification is a good concept or a bad concept to employ as an investor. And if you don't understand what diversification is, we're going to cover that. And if you don't understand why I would be asking this question in the first place, we're going to cover that too, right? So I want you guys to be better informed investors, and I want you to understand that one of these major concepts when it comes to taking risk off a portfolio is diversification, and I want you to understand whether or not this is something that you need to be doing actively and whether or not it is actually a good idea for your portfolio and for the growth of your investments over the long term. But before we get started, if you could go down below, hit the big red subscribe button, like this video, leave me any feedback in the comments down below, and I'll be sure to respond to anything you leave down there. If you're listening on Apple or Spotify podcasts, be sure to subscribe and leave me a review on either one of those platforms. Follow me on social media at MNO with Dylan, and that's really good supplemental materials to all the things I'm putting out in these long form episodes on YouTube and the podcast every single day. And then if you need somebody to help you to build a financial plan that is specific to you and your family's needs, then I can do that. Just contact me on any of the major social media sites, Twitter, Instagram, Facebook, and I will be more than glad to set up a financial coaching session with you and help you to begin walking through a financial plan that will ultimately get you to your financial goals and long-term financial freedom. So let's just start. If we're going to ask if diversification is a good or bad thing, let's just start with what is diversification, okay? Because before we can determine if something's good or bad, we have to determine what something is, okay? So what diversification is a risk management strategy that mixes a wide variety of investments within a portfolio. A diversified portfolio contains a mix of distinct asset types and investment vehicles in an attempt at limiting exposure to any single asset or single risk. The rationale behind this technique is that a portfolio constructed of different kinds of assets will, on average, yield higher long-term returns and lower the risk of any individual holding or security. Okay, so basically all diversification is to diversify your portfolio. So when we think of diversity or diversifying something, we're thinking of a bunch of things that aren't the same, right? A bunch of things that are not the exact same as one another. And so that's what we're talking about when we're talking about diversification within your portfolio. And that really shows up in two specific ways. You either have within asset class diversification, and then you have asset allocation, which is a way that you can diversify your investments as well. Okay, so just basic within asset class diversification is like if I have a bunch of large cap stocks within a portfolio, or I own a mutual fund that tracks large cap stocks, I may want to also own a mutual fund that tracks the small cap stocks, right? Because small cap stocks are not going to be directly correlated with large cap stocks. Okay, so that is within asset class, and the asset class being stocks or equity funds, right? And then just buying different types of equity funds. Or you may diversify by saying, well, if I have some U.S. stock funds like the S&P 500 index fund, maybe I will buy some international index funds in order to diversify my portfolio. Now, what's the point? Why is this done? This is done so that if one were to go down a lot, maybe the other one doesn't go down as much, or the other one doesn't go down at all. Maybe the other one increases, right? We're looking for a lack of correlation between assets, right? And it's difficult to find true lack of correlation within one asset class, right? Because that asset class is going to have some, just systematic risk that is inherent to it, right? But when we talk about different asset classes, when we talk about asset allocation, that is far and away the best way to get lack of correlation within a portfolio, because you're taking actually different asset classes. So you're taking stocks, and you're taking bonds, and you're taking commodities, and you're taking real estate, and all these different things into your portfolio. And ultimately what your hope is that the returns on these different asset classes will cancel one another out. Now, not cancel each other out to where they're zero, right? But if one does really well, maybe another one won't do quite as well during that time. Or if one is doing really bad, then maybe the entire portfolio can be better held up by some of the other assets that you hold. Right? This is the idea of asset allocation. Okay, and it is a way that we diversify our portfolio. Now, diversification strives to smooth out the unsystematic risk events in a portfolio. An unsystematic risk is like company specific risk or security specific risk, meaning one holding, the risk that that one holding has, right? And it looks to smooth out that risk in a portfolio, so the positive performance of some investments neutralizes the negative performance of others. The benefits of diversification hold only if the securities in the portfolio are not perfectly correlated. So that means if you buy a bunch of assets that are just very highly correlated with one another, even though you may be buying different assets, if they're highly correlated with one another, then the benefits of diversification are not going to show through. Okay, so in general, this is what we have. This is what diversification is. And studies, right, have shown that maintaining a well-diversified portfolio of 25 to 30 stocks yields the most cost-effective level of risk reduction. The investing in more securities generates further diversification benefits, albeit at a drastically smaller rate. So you have this decreasing marginal benefit of diversification over that 25 or 30 individual stocks that you may own when we're talking about owning individual stocks, right? All right, so that's what diversification is. So we haven't answered the question, though, is it good or is it bad? Well, I want to start, and really the crux of this question comes from two huge billionaires and huge investors and just moguls, right, of the business world. And they are Mark Cuban, right, who everybody knows from Shark Tank and the owner of the Dallas Mavericks, and Warren Buffett. Okay, so what did they have to say specifically about diversification? Well, billionaire investor Mark Cuban said diversification is for idiots. Warren Buffett claimed diversification is really just a protection against ignorance for novice investors. Dozens of articles across the web, they come to the same conclusion that diversification can be an unnecessary precaution, right? There is a kernel of truth in their opinion, right? If you're in a special class of investors, right, there is truth if you are a special class of investor and a special class of individual. And we'll talk about what that class is here in just a little while. But both Cuban and Warren Buffett made fortunes by investing. And every investment they make is based on careful research, expert advice, and decades of experience. They have little need for diversification because their moves are calculated. To them, diversification would be like putting training wheels on a motorcycle. It's an unnecessary precaution for a fast and powerful machine. Okay, but what if you're not Warren Buffett or Mark Cuban? What if you don't have the knowledge of markets that they have? What if you don't have the abilities that they have as investors and the understandings that they have as investors? Do things change, right? Well, that's what I really want to get to the bottom of in today's episode. I want to understand and help you to understand more if these benefits of diversification are actually good for all of us. And if they're not good for all of us, then in what context are they not good? Right? Because obviously these are two of the biggest guys out there when it comes to investing. And if they are saying that it's just a protection against ignorance and it's for idiots, right, then maybe we need to listen to that. Maybe we need to take heed to those statements and try to better understand exactly what they're saying and exactly how a concept like diversification can maybe hinder us in our investing, but we also need to understand the positives. So what I want to get into are the positives and the negatives of diversification. But before we do that, I do want us to see if, as Americans, as investors, if we even know what diversification is or if we even pay attention to it at all, because it's such a big buzzword in investing and in personal finance. But the question is, do people even take notice of diversification? Well, when investing, right, a diversified portfolio comes up pretty often, but maybe you're not sure what that even means. 1 in 4 Americans say that they don't know or they have no opinion on whether their investments are diversified, according to a survey of 2,200 U.S. adults that CNBC performed in conjunction with Morning Consult. Another 42% of respondents say that they don't actively monitor to make sure that their investments are diversified, and only about 34% of people say they do. So only 34% of people are actively making sure that their portfolio is diversified, right? Now, the question is, are these 34% of people the right 34% of people, or are they the wrong 34% of people? Well, many would argue, well, of course, they're the right 34% of people. But I would also argue that, based on what Buffett and Cuban said, that maybe these individuals aren't doing the right thing. But in general, we have to remember what the individual investor is, right? Most individual investors are not buying individual stocks. Most individual investors are not putting a ton of money away, right? Most individual investors are putting modest amounts of money away into employer-sponsored retirement accounts like 401ks. They're not buying individual stocks. They're not doing research on individual stocks. They're just buying these funds that their work offers them, right? And many people don't actually take the time to even look at those investments. So to see that so few people are interested or understand diversification is not surprising, right? But it brings us to ask the question, like, should they be worried about it? Should they be worried about it? Is it a good thing to be worried about? Now, obviously, understanding what you're invested in is a very good thing to be worried about. You need to know what you own. You need to understand what your investments are, right? So that is 100% a good thing, right? But if you're not paying attention to diversification, should you be? And if you are, right, should you not be paying attention to diversification as much as you are, right? That is the big question. I think the lack of education has led us to where, we have a bunch of people who don't know what it is. We have a bunch of people who are not interested in it. And then some people who actually try to do it, but maybe they try to do it based on the fact that they have these old school ideas of what investing is. And we have to ask ourselves if those old school ideas still hold or not. So for the duration of this video, I want to give you guys the pros and the cons of diversification strategies. And then I want to give you my opinion as to how diversification should play a part in your portfolio and whether or not you should be taking heed of it at all. So the first pro of diversification is that it eliminates the cyclical nature of the standard economy. Economies grow and economies slow down. Right? When that happens, people change their spending habits. When money is tight, there will be fewer new cars purchased and fewer new mortgages going to home buyers. When money is more available, the luxury items are more likely to be purchased. Diversification allows a portfolio to weather these cycles because a little bit is owned in numerous industries. So some things are always up while others are always down, right? So it takes away some of the cyclical nature of the economy, right? It takes away some of the fact that you could be invested in a bunch of auto industry stocks. And, if the auto industry is going through a slump, then you are taking that slump with them and are not getting any positive price action from your stocks. Or, if you own some home builders, right? If you've owned home builders in the past year, you've gotten a really big run up in the stocks of those home builders. But if you had been invested in, large cap tech, especially in the past 3 months or so, right, you've taken a lot of pain. Right? But what this does, and these are all cycles, right? This is all cycles of the economy, cycles of the stock market. But what diversification does is it smooths out those cycles and it allows you to have some things that are going up and some things that are going down at all times, which can be beneficial. So that is the first pro of a diversification strategy. Then what is the second pro of a diversification strategy? Well, there will always be unpleasant surprises. A promising medical breakthrough doesn't happen as expected. The mining company with consistent returns suddenly experiences a collapse at one of their locations. Even leaders such as Steve Jobs can create uncertainty when medical issues affect their performance. The bottom line is this: any investment can be struck by an unpleasant surprise. Being diversified can help you to take the shock off of that bad news. Right? So there are stocks that, and companies, right? Underlying companies that have very good performances, very good track records. They're doing all of the right things. But one piece of bad news can really throw a wrench into all of it. Right? And so what diversification does for you as an investor is it allows you to be less affected by the fact that a wrench has been thrown into a specific company or specific industry's issues, right? COVID-19 is a perfect example of this because it really put a damper on a lot of industries. There were a ton of investors in cruise lines, right? A bunch of people invested in those types of stocks, and it is very uncertain as to what the cruise line industry will look like moving forward. There are a ton of investors in airline stocks, and who knows how airlines are going to fare moving forward, okay? So there will always be unpleasant surprises, but diversifying allows you to take a little bit of the heat off of those unpleasant surprises. Then, third pro of diversification, certain investments make diversification easy for the casual investor, right? So when we talk about mutual funds and we talk about index funds and we talk about balanced funds, we talk about all these different fund investments, right? They are making diversification easy for you. Diversification is very easy, right? I talk all the time about if I could just invest in one thing in the stock market and hold it forever, it would be the S&P 500 index fund. And it is a diversified group of large cap United States stocks, right? And so I would invest in a diversified portfolio if I could only invest in that one thing. And I do have a lot of money invested in the diversified S&P 500 index, right? Well, these types of investments just make it easy for people who only invest in 401ks or only put money into their IRAs or not looking to do any type of research. They make it easy for them to get good returns and be very casual about the fact that they just add money to their investments and don't really worry about being diversified and don't really worry about what's going to happen next. They just keep investing and keep investing and keep investing. So it is very easy to diversify and it is very cheap to diversify, and it takes a lot of the stress away from the picking of individual stocks, of individual securities to hold within your portfolio. So that's the third thing. The fourth pro of diversification is that diversification helps to maximize the use of potentially underutilized resources. Okay, sometimes an investment doesn't perform as it should. It's just like a business expecting a product to perform one way, but the results come back to show that it performed a very different way. With the right strategy, these underperforming components of a portfolio can be liquidated and then placed into diversified components that do have a proven reputation of success. This allows more money to grow over a longer period of time. Right? So if you have things in your portfolio that are underperforming and consistently underperforming, not just underperforming over a short period of time, but are doing so consistently, and you find that your diversified portfolio takes a lot of the stress away from you picking individual things to invest in, and you can make good returns over the long term, then you can invest in the diversified portfolio, and it can provide you reasonably predictable returns over the long term. Okay? Now, the fifth pro of investing in a diversified strategy is that growth is based on the expertise of others, right? Although you need to perform your due diligence to discover what industries tend to be up when others tend to be down, that's the extent of what the casual investor typically needs to do when it comes to homework, when it comes to work outside of their individual portfolio. I've told you before, if you're going about picking funds, right, and you know what type of funds you're going to purchase, right, whether it's going to be stock funds or bond funds or a certain type of large cap stock fund or international stocks or domestic stocks, whatever it may be, right, if you're going to pick a stock fund, it is not quite as important that that fund has really just blown out the market over the long term as it is that it is low cost, that it is indexed, right? And it's not a very actively managed fund. It's got very low turnover of the shares within it. These are the things you need to look at to make sure you get good positive returns over time, because otherwise, right, a lot of equity funds are going to be really close to each other in return, and a lot of index funds are going to be just like each other when it comes to return, right? So your growth is not based on you going out and picking out individual companies. The growth is based on the fact that a group of diversified stocks, a diversified group of companies can perform well over the long term. And as long as you keep pouring money into them, they will provide you a good rate of return. So the growth is based on the expertise of others and not your expertise of a particular company, a particular industry, or sector of the economy. Then the sixth and last pro of a diversification strategy is that it provides movement away from activities which may be declining. So sometimes an industry will go down for a while because of economic factors. Then there are times when an industry will be completely eliminated. After all, when was the last time you went to purchase a yoke and a plow for your livestock? You really never have, unless you're in that type of rural area and you own livestock and you do things a very old school way. But otherwise, that is just not very common. Diversification allows investors to have movement away from activities which may be declining financially, so their strategy can always provide them with some sort of growth, right? I make the argument all the time that the S&P 500 index, the reason that it's such a good investment over the long term is because the companies in it today aren't necessarily going to be the companies in it tomorrow. And that can be a good thing and a bad thing, but the reason that the companies in it today aren't going to be the ones that are in it 10 years from now and 20 years from now are because better companies are going to come along and dominate the index, right? And some of the companies in the index are going to fall out of the index. And so it has this bias towards survivorship. It has a bias towards companies that are doing the right things, doing good things, especially the S&P 500 index does this, right? So it moves your money away from activities and companies that are doing things that are losing money and that are detrimental to the value of your investments, and it moves them towards things that are actually valuable and actually going to create value for your investments over the long term. And it does so without you having to make any type of investment decisions, which is extremely meaningful, and it keeps emotions out of your investments, which is a huge thing. So there are the 6 pros of a diversification strategy. Now, to balance that out, I wanted to give 6 cons of a diversification strategy. Okay. Now, the first con of the diversification strategy is that it naturally limits your growth opportunities. Well, of course it does, right? And I'll tell you exactly how. Okay. Let's just use a very basic example. Okay. If last year, right, 2020, in January, I had, a portfolio that was half Tesla and half AT&T, right? AT&T is a very stable stock. It doesn't go up in value by a ton. They pay a big dividend, right? It's not a growth company by any means, right? But I put half of my portfolio there and I put half of my portfolio in Tesla, okay? The Tesla portion of my portfolio since that time has absolutely skyrocketed. Hundreds of % of growth since just last January, okay? But the AT&T portion, right, it's grown, but it hasn't grown to an outstanding extent, right? And I could have made dividends off of it, which would have been beneficial, right? But the growth would have come basically from the Tesla portion of my portfolio. But if instead of half and half, I held the entire portfolio in Tesla, right, then you would have made the full returns of Tesla, right? You would have just made the Tesla returns, which would have increased the growth opportunities that you had. So every time that you try to diversify a little bit with adding another stock, it takes away from the ability of one particular company and their growth to be able to shoot your growth opportunities upward, right? It takes away from the fact that Tesla made hundreds of % if you own something in your portfolio that lost money over the last year and a half, right? It naturally is going to limit your growth opportunities, which is a big reason why a lot of people do not like diversification. Then the second con to diversification is that even diversification can lose money over time. Many investors will have bonds in their portfolio to help offset broad declines in the stock market that may happen. The only problem with this is that even municipal bonds, which are about as much of a sure thing as one can get, can lose money if their credit status changes or there are suspicious activities taking place which require an investigation. So even within a diversified strategy, you can lose money, right? Even if you own the S&P 500, right? The S&P 500 has had several drops of 30, 40, 50% plus over its lifetime. So that can absolutely happen to you. And if you own like balanced funds or things of the like, and let's say interest rates rise, well, what happens when interest rates rise? Bond prices fall, right? And when interest rates rise, what else happens? Well, stocks don't necessarily like that because companies can't borrow as cheaply, right? So even a diversified portfolio can lose you money over some period of time. Then, third con of a diversification strategy, some ETF investments for diversification are too diversified, right? You could argue that a bunch of mutual funds are as well, where they hold thousands of companies, right? We read earlier and we talked earlier about how 25 to 30 stocks is really where the main benefit from diversification stops. So why would you add thousands of companies to a portfolio? Or many may argue, why would you even buy an S&P 500 portfolio that has 500 companies in it, right? Because that is maybe too diversified. Investors need to always be wary of anything that seems too good to be true when they're looking to diversify. Some alternative mutual funds can perform very well because when asset classes are tracking too many different assets, then the cost of investment becomes problematic, right? So you always need to take that into account and understand that you can be over diversified. Then the fourth con, there can be unexpected tax complications. If you're investing into gold ETFs, for example, then the returns that are received from the buying and selling process are taxed at capital gains rates. Other income may only be taxed at the 15% rate or the 20% rate, depending on personal income tax levels. That's why the best advice when it comes to diversification is to not invest in something that's not completely understood, right? So you need to invest in what you understand and understand the tax implications of the diversification that you're doing. Then, fifth con, it adds complexity to the investment process. If you have $200,000 to invest, then it's much easier to dump that money into just one investment, right? Now, obviously, you can invest into one diversified mutual fund or one diversified balance fund or whatever it may be, right? But if you break it up into 10 investments of $20,000 each, then you've got 10 companies where you've got to perform your due diligence. You've got to do the research. This means that not only is there an added complexity to the portfolio, but there are likely to be added management and bureaucratic costs, which may be paid to maintain the investments over the long term. So we want to keep our costs low, and we want to have the least complexity possible with our investments, and being overly diversified, being diversified over any reasonable number of companies can allow us to have too much complexity. Then the last con, there can be political and legal influences which change an investor's life. Rupert Murdoch is an excellent example of this. He became a U.S. citizen in 1985 because non-U.S. citizens were only allowed to own a maximum of 25% equity in any company which held a broadcasting license. His strategy essentially forced him to accept citizenship. Although this example is somewhat extreme, the same basic rule applies to all investors. Political and legal influences can be costly in multiple ways. Okay, so this is something that is very rare. There's not as many issues around the individual investor here, but this can be the case with larger investors with larger amounts of money. Now, what do I think, right? Maybe you came here for my opinion as to how I deal with diversification, how I diversify my portfolio, how I may not diversify my portfolio. Well, let me give you this, okay? I believe that the vast majority of what you have, right, the vast majority of what you invest should be in diversified groups of mutual funds, index funds, whatever it may be. I think diversification is useful. It helps to provide you good long-term returns, and it keeps volatility down over the long term. But you can still make returns that are going to be market-based returns, okay? So it's nothing that is far too negative over the long term. Now, that is for individuals, especially individuals who don't want to do a lot of research, don't care too much about picking individual securities. I think if you're going to just be the casual investor, then the casual investor doesn't need to worry too much about diversification, because the investments that you're going to buy are naturally going to be diversified because you're buying ETFs and mutual funds and things of the like. Just buy good ones, buy low cost ones, and buy indexed ones, and those are going to suit you the best over the long term. But what about individual companies, right? Buying individual stocks. Do I think it's important to diversify when you buy individual stocks? Absolutely not. I don't think diversification is especially useful when buying individual companies, okay? I think what's more useful when you're buying individual companies is understanding the company, understanding what you see over the long term in that company, right? Having a good basis for investment, understanding the fundamentals, and being able to project into the future the fact that that company is going to provide you returns, okay? Now, me saying that I don't necessarily believe in diversification of individual stocks doesn't mean that I don't believe in holding multiple individual stocks. Of course, I believe that you should hold somewhere between 6, 10, 12 individual stocks. I know today we talked about 25 to 30, but that's just a lot of due diligence that you have to do. If you can understand 6, 12 businesses very, very well, then it's easier to manage, and you can be very sure that your higher conviction names are going to provide you good returns over the long term, and you're not diversifying too much to where extra stocks are going to take away from the returns that you can make on your higher conviction names. So I wholeheartedly believe in not just holding everything in one stock, right? And I wholeheartedly believe that most of the things that you hold should be in diversified groups of companies. But if you are purchasing individual stocks, on top of your mutual fund, your index fund, your ETF investing, then that doesn't have to be fully diversified out. And it doesn't have to be where you have to understand a bunch of different things. Find some things that you understand. Find some companies that you understand, where you understand where they're getting their revenues from. You understand how their growth can be projected into the future, and own those, and add to them, and add to them, and add to them, and add to your high conviction names, and get out of names that you're not as convicted about. Okay, so I see both sides. I see what Warren Buffett and Mark Cuban are saying, because they're buying individual companies and they're just trying to understand those individual companies as best they can. That makes perfect sense, right? But if you're a casual investor, you need to save yourself from ignorance, right? It's a protection against ignorance, like Warren Buffett says. And ignorance is not always a terrible thing. You just have to have a general understanding of what you're invested in. You have to have a general idea of what a mutual fund is, an index fund is, what the costs are, things like that. But you don't have to understand every company within an index fund or mutual fund. Just buy the fund and continue to buy the fund over the long term. And it has proven to be a successful strategy. And it does help you to protect yourself against any ignorance that you may have about individual companies. But never get into buying individual stocks if you don't understand the companies, if you aren't willing to take a little more risk in that way. Because naturally, less diversification is going to be more volatility, therefore more risk, right? But naturally, if you own good names, it can provide you the highest returns, which is why Mark Cuban and Warren Buffett are some of the richest men in the world. So thanks for watching this episode. If you could go down below, hit the big red subscribe button, like this video, leave me any feedback in the comments down below, and I'll be sure to respond to anything you leave down there. If you're listening on Apple or Spotify podcasts, be sure to subscribe and leave me a review on either one of those platforms. Follow me on social media at MNO with Dylan, and that's really good supplemental materials to all the things I'm putting out in these long form episodes on YouTube and the podcast every single day. And then if you need somebody to help you to build a financial plan and keep you accountable to that plan over the long term, then I can do that. Just message me on Instagram, Twitter, Facebook, any of the major social media sites that you can find me on, and let me know that you're interested in financial coaching, and we can set up a financial coaching session that will help push you towards your long-term financial goals and ultimately the goal of long-term financial freedom. So tune in Monday as I continue to share with you guys personal finance topics that I think can be useful for you in your long-term financial journey. So thanks for tuning into this episode of Money's No Object. I'm your host, Dylan Howell. God bless.